money is flowing into the apartment space, not as much into the other sectors, because it's seen as a safe bet. And some of the articles I don't think we're going to get to today are looking at, that home ownership rate for millennials is way down. They're not able to buy enough homes. Interest rates are going to help to some degree. It's going to be increase the velocity of home ownership and travel and how people are moving in and moving out. I think a quicker reaction is, okay, is this going to be bad for apartments because interest rates are going to come down? What we've learned is that when people are moving, buying a house, leasing an apartment, housing demand is housing demand.
I put that in the notes.
Housing demand is housing demand. You said it to me. It's gonna be a shirt.
And another phrase that we say a lot too is would-be home buyers, and there's going to still be would-be home buyers because the housing prices are going to go up.
That's the thing. It's not like interest rates are low and the prices are low also, and it's a great time to buy. Prices are high. They're going to go higher. Interest rates coming down are only going to make those prices even higher. And even though your monthly payment may be down, that down payment's not changing. I mean, obviously there's talk about some down payment assistance with the Kamala administration if that ever happens. We'll see if that ever happens. But even as we've talked about that, the effect of that will most likely just be more expensive housing also. So the question is, who can come up with the $50, $60, $100, $200,000 needed for a down payment to buy a house? Not that many people have that amount of cash just sitting around. Some folks are getting help from their parents or whoever.
That's a big barrier.
It's a huge barrier. And we're going to have there are a lot of really nice apartments that have been built this year and the last year. So there's a lot of options for millennials looking for a high-end luxury apartment experience.
It's interesting because I just talked to Jay a little bit about how there could be a little bit of an improvement in home ownership for millennials compared to like Gen X's at the certain age, but overall it is trending lower, and each successive generation had lower home ownership levels than the previous generation, which to me says that this is a huge or bigger trend that it's bigger than the generations. And I would also note that Jerome Powell didn't really say that low interest rates are going to cure the housing crisis. He really made a specific point, like this is a kind of housing supply problem, and housing affordability is not going to go away overnight. There was even one point when someone may have reiterated or said the same question and talked about housing, and he didn't really even answer it. Like, it is a bigger problem, and you can't dial the knobs of interest rates and solve housing. It may make the homes cheaper, but then you got your mortgage rate you're going to deal with, and if you turn down the mortgage rate, that could make the home prices more expensive. So there's not an easy way out except for building more supply, and one of that crucial source of supply is multifamily apartments.
Yeah, very, very, very true. We're going to need more supply. That's just without a doubt, Matt. And where's it going to come from? There were a lot of other pieces to the summary of economic projections, some forecasting on GDP. This we're looking at basically kind of the range of where interest rates are going to be going. But essentially looking at the projections for that's PCE inflation, looking at GDP, that's unemployment rate. Here we go. Here's GDP. Look for the rest of 2024. And they definitely, and this is the big difference. You see this kind of like this dotted line. Those were June's projections. You see it was a much broader range of opinions where it's concentrated a little bit. There's a very few participants that see GDP kind of really above 2.2%. There's really kind of only like one person that thinks 2.2 to 2.3. One participant thinks 2.7 to 2.6. The vast majority are between 1.8, 1.9, really 1.8 and 2.1. Again, that's a big shift, with the consensus being kind of right at 2%, which is where they would kind of like to see.
But
that's
in
2024.
General, it seems like 2024's numbers shifted down a little bit. The 2024 numbers.
Yep, they've shifted down. In 2025, it kind of similar to where they were last month, although a little bit more to the downside of more participants. I'm thinking that we're going to be in the 1.8 to 1.9 range rather than the right at the 2% handle. But there are still some participants that are going to that believe that we may see slightly stronger growth, kind of in that 2.3 to 2.5% GDP range. And looking out into the future, and as we go on into 2026 and 27, I mean, it's even more speculation. But they're not calling for. Here's what they're not calling for. They're not calling for accelerated inflation. At least when we're looking at GDP. If we actually look at PCE inflation, so this is unemployment rate, PCE inflation. I mean, this is, I think, the big difference where they really kind of dialed it back. Where just starting in 2025, the consensus was more in the 2.3 to 2.4% range of inflation. The vast majority of participants now believe that the PCE inflation is going to be right, but at 2.1 to 2.2, much closer to their target of 2%. Basically saying, hey, look, we're slowing down, but we're slowing down right to where we want it to be. Matt, the flaps have been put up. The landing gear is down and the flaps are up, and they're saying that we are getting ready to achieve this soft landing. Again, with even more participants in 2026 thinking that PCE inflation will be right at 1.9 to 2%. Go ahead, Matt.
Just this over, and we noted this before, just kind of the overarching implication that, you caused this, your high rates have caused this labor market, these labor market troubles. I think he did a lot of work, rhetorically, I think, to characterize the employment market as normalizing and healthy rather than heading towards disaster. And I'm going to mildly agree with him, but I'm a little bit more worried. I think his job is to kind of be more reassuring in this situation. But I think that it's not like there's not like if you look at the numbers, we could be headed for a recession. It seems like employment always seems to like.
Just said I can always paint you.
That's a good point.
I draw you a map to recession in any market. I think that risk is always there, but again. As Jerome Powell said, and I quote, "Business people doing business things think it's fine."
Yeah, that's a good quote. That's what I also had to score. The U.S. economy is basically fine. On the other hand, yes, he was reassuring this time.
But he picks his words so carefully. What is basically fine?
Yeah, I know.
Basically fine. It's like he's like it's a qualifier.
He's good at his job.
He's deciding to not call it fine.
Yeah.
What's the difference between fine and basically fine?
And this is another thing too that I thought that it was continually earlier in the questions rather than later. He did not want to be on rails, right? He didn't want to make people think like, oh yeah, we've got it planned out and this is what's going to do. Boom, 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 boom. Look at the dot plot and that's what's going to happen. No, he wanted the idea of them reacting to the economy is an important check. It's an important power that the Fed has psychologically that will maybe like chasten and govern economic behavior just as much as
they want to reserve their power and to be able to affect monetary policy.
Yeah, for sure,
100%. So just want to bring up again just one of these graphs looking at. We'll do it big so everyone can actually. Everyone actually see it. This is again basically kind of we're looking at the dot plot, but it's their projections for the range of the Fed funds rate starting in 2025. And again, this is just kind of lining up where everybody is, just a different way. And I like this again because it shows us where they were back in July and how that's changed. You see, back in July, the consensus for 2025 for the Fed funds rate was really kind of in this 4.13 to 4.37 range that's shaded here. And now we've moved back almost 100 basis points, Matt, between 3.13 and 3.62. That's a big change. Also, in 2026, it's moved back where the consensus now is kind of in that 2.88 to 3.12 range where it was 3.13. Almost basically moving forward rate cuts an entire year, which I think is fascinating. And, then outside of that, who knows? But they're basically going to say it's going to stay around that range, and they don't know. We don't know.
2.5, 2.8 as the overall longer run.
So what is this? One thing for multifamily investors that you want to remind, I guess, to take away from that is, again, coming back to that interest rate cap rate correlation. And that, perfect. So just got the question. So when we see interest rates, on that gradual slope down, again, volatility of interest rates spiking, one day, I mean, that can cool the market. but we're looking for like longer drawn out effects. And so the longer effects of interest rates declining over the next couple of years, one would think you'll see a correlation of cap rates also declining over the next several years. And again, a little bit of that has already been priced in with the 10-year Treasury. When it would dip below 4% in anticipation of these cuts, buyers were coming back into the market. We've talked about a handful of just anecdotes that we've seen just have direct experience with for projects that started getting bid up because of the anticipated interest rate environment. And I think that it's really unleashed a lot of institutional capital back into the system, and they're going after these deals. Now, what they're not finding is distressed deals. We talked about that. They're finding what's out there is newer construction deals, and then deals that are older and have had some issues, but they're still trading for a premium. There's a lot of what's on the market. There's a lot of high quality properties on the market. Again, the rent growth for those properties aren't really high right now, but you're buying quality properties at a similar cap rate as some of the more workforce housing B and C class assets are trading for, and then some of the really rough distress kind of C and below product. There's just not a whole lot of appetite for right now at all. It's hard to finance it.
That's
it's hard to
difficult,
insure it.
And that'll be difficult for affordable housing. That's interesting. I also wonder, you've got to factor in. So what you may be saying is right now they might be pricing in future rate cuts, but then how much are they pricing in, and how much are you going to have to kind of sit with and eat, basically, in terms of like the lower rent growth for about a year before things can realize? And the balance may be overweighted. Things may be overpriced. I think that especially in the kind of fervor of it right now, people may bid up a little bit too much. But that was
and do you change your financing strategy also?
Yeah.
Whereas now, are you more open to floating rate debt? Maybe even going a bridge route where kind of bridge debt and floating rate debt has been kind of like a bad word over the last 18, 24 months. But now, if interest rates are declining, do you ride that wave down of lowering rates, and then as cap rates lowering and interest rates are lower in 2 years, you refinance at a higher valuation at a lower rate, do a cash out refinance. Doesn't seem like the craziest strategy. And in that environment, you could say, well, maybe we don't get an incredible amount of rent growth, but rates are but we're going to be making more net cash flow because our debt service payments going to decline, and from just the capital markets perspective, cap rates are going to come down. We'll be able to refinance, and so we're going to be able to extract that appreciation really through more, again, capital gains, capital appreciation, rather than really operational performance.
Yeah, because that's what I was kind of thinking about too. Is you get lower rates, and maybe they're pricing in somewhat, but you may be getting in the most optimistic situation. You get more rent growth, you get lower
you could see
debt
both.
payments, and then you also get higher pricing or lower cap rates. All these kind of confluence of things that kind of build on each other.
Yeah, and the other piece I didn't mention there is, and I kind of discounted it, is the rent growth, because I think it's reasonable to say that, hey, we're not going to see a lot of rent growth. Things are going to be relatively slow. I think there's also an argument that says, look, once this supply has been delivered, not now, but in a year and a half to 2 years, we actually could see some pretty strong rent growth. Now, when you look back in history, and you look back the last couple cycles, after we've gone through a period of negative rent growth, every single time after that, we've seen a spike in rent growth. Now, there's a lot of things that are different about what this cycle or whatever period that we call this, and so you kind of can't count on like the normal things to always happen in a cycle of this happens and then that, and just a series of events. But there is a lot of housing demand, and so all of the ingredients are there for accelerated rent growth. And I'm not saying the rent growth that we saw in 2021. I'm saying moderate rent growth, kind of in that 4 to 6% range. I don't think is off the table. And then so if you do get kind of the hat trick of lowering cap rates, lowering interest rates, and increased rent and higher rents, it could be an absolute incredible time to acquire real estate. But you have to stomach low cash flow, maybe in that first year or two, just to be able to have the chance. So I would say that there is maybe not higher degree of risk, but there's risk. There's absolutely risk. But what's different now compared to 2023 is that there's actually upside and potential reward.
I know, because we were saying this in 2023. It's like, yeah, you just have to wait through this 2023 or wait through 2024, and then but if I had to go back and change, I would say, yes, there is light, but man, it's going to be about a year longer than you think it is. And even when the numbers work, right? Even when the debt is right, you're still going to have to wait for the apartment supply to kind of normalize so that things work out that way.
I guess the concern could be because, you could say, okay, we've bottomed and we're on the upswing, whereas we were still coming down, and we don't no one who wanted to catch a falling knife.
Yeah.
Okay, well, now the knife's like, you've heard the ding, it's on the ground. It's like, it seems like it's clear. And I'm just throwing this out for conversation's sake, is, there could be a double dip down. We could see some sort of like, dead cat bounce of where, like, all right, we bounce up a little bit, people are excited, and then, some major, so whether it's a black swan or, call the event. Maybe inflation, ramps back up, and they have to increase rates again, or some sort of
or just considering how slow it's moved. Anyways, the knife could have fallen. We know that bad thing's over, but it still stagnates for a long time before it actually recovers, because of the size of this of the apartment supply. Like, we are past the worst of it, but there's still challenges. It's still not going to be.
Or maybe everybody brings their property to market, they try to sell, and there's too much supply in the market of properties to sell, and prices start coming down. You can paint this scenario. As I talk through that scenario, it doesn't always really kind of line up with, I think, what makes sense. But I think there is that concern there. But I think the base case is that we've set up pretty solidly. The fundamentals are set up pretty well for the next couple of years, 5 years.
I am super interested in knowing if, first of all, like, I don't have like a perfect view of how much of what deal activity is right now. My assumption is that it's pretty low. I wonder if the character of the market does change once deal activity increases. Like right now, it is few and far between. It's kind of a little bit of even though you've talked about like how the broken through, but the small amount of deals that exist mean there's certain elements where it is a seller's market. And so when you get more sellers, how is that going to change? Are sellers going to have a little less leverage because they're not the only guys out there selling?
I'd say it's relatively balanced right now between buyers and sellers. We could see that shift again to where being much more of a seller's market. It was definitely a buyer's market a couple months ago. It's much more balanced today. And back to your earlier question when we were talking about kind of just timing and like what's going to happen before the end of the year. I think we're thinking about it in those terms, but like if you take like the end of the year out of it, and people are ready to do deals. And it doesn't, in some cases it has to be done. We got to close it before the end of the year, but unless you have, there can be reasons. They can be tax reasons. They could be, you may have a loan expiration, but you close in December. Sometimes closing mid-January is way better than closing in December.